ladies and gentlemen, for another episode of Likeable Fitness. You're now rocking with your boy, Major Walla. And you know this channel is all about seeing the American consumer do better and be better. And today in this episode, we're going to be talking about what is revolving credit, when it's the whole concept behind credit cards. So stay tuned and let's get it.
This motivation, suck, get on your job. If you hate, get on your job. You can look me in my eyes, see I'm ready for whatever. Anything don't kill me, make me better.
Welcome back. You tuned in this video to learn about revolving credit because it's something that you might need to know. Access to revolving credit gives you a kind of a It gives you kind of a get out of jail free card to a sense. Now, the benefits of revolving credit are undeniable and it helps people from all walks of life. But they do come with some downside. And today, in this video, I'm going to be going over what revolving credit is, the benefits of using it, and some of the common examples of the form of revolving credit you can have. So, what is revolving credit? It's the short-term form of credit where the borrower can continue using their credit limit over a period of time, normally within 30 days, because that's when, and they send you your statements. That's why it's important to know what your due date is, what your statement date is, and what your report date is. Revolving credit can be used for numerous different purposes, though some cards can have restrictions on it. So, as long as you pay your bill on time and keep your account in good standing, you'll be good with your revolving credit line. And it can be used as many times as you want, because every revolving credit is going to have a set limit that you have. So as long as you don't go over that limit, you can continue using your card and pay it off and use it again. That's when you hear the terms evergreen loan or open-ended credit plans. Now, you want to remember, when it comes to revolving credit, flexibility is key. It's the key element to it. That's why it's so enticing to people. It's very enticing because the borrower get to choose how much of their credit limit they get to use, whether they want to pay the balance off right away or over time, and what they want to spend their money on. Now, comparing to installment loans, revolving credit, it gives the consumer access to credit to be able to spend the way that they want to spend, depending on particular circumstances they may find themselves in. In addition to flexibility, there's plenty of the reason why we're using revolving credit is so good. It allows you to have financial cushions when emergencies present themselves. It allows you to help you manage your cash flow. And it provides a level of theft protection to your money. And it gives you reward points for everyday purchases. All fraudulent expenses that are placed on your credit card, they do not fall on you. They are able to be disputed and refunded back to your card. That allows you to have a peace of mind to know that if someone was to steal your card, like if they steal your debit card, they're able to have access to your funds. But with your credit card, if they start making fraudulent claims on your credit card, guess what? You get to dispute all those charges and you get your money back. And it's so. That's why it's so smart to use your credit cards when you are swiping away instead of using your debit cards. Okay, welcome back, people. All right, so now that we know what it is, what revolving credit is, let's talk about how it works. All right, so check it. A lender is your credit limit on the approved credit card or line of credit. So now they have several factors that they use to determine this credit limit. One could be debt to income ratio, credit score, and you probably want to have at least above a 620 and above before you really try to going in and applying for the higher end credit cards. Total income, once you're applying and they asking for your income, they speaking on the total house income. So if you have however many people in this house that is earning a income and paying taxes, you can use that income. You can add all of it together and put it as your total income. Okay, so that's one of the hacks that you can use to get some of the high end credit cards that you need a higher income. So now once they ask for tax documents or anything like that, guess what? You can always get the tax document for the people that's in your household. Credit report details, making sure that you have no negative items on your credit report, and depending on how the market conditions look. Like right now, the state of the U.S. economy, they try to say, which I don't believe in because I'm recession proof, but they try to say we're in a recession right now. So that's what's kind of sort of what the market conditions consist of. But in the case of a home equity line of credit or a secured credit card, the bank may also require the rights to collateral such as a house or funds to secure that credit account and to reduce their risk. They trying to cover themselves in case that you do default. So if you default, they'll use your home or they'll make you put up money when you have secured credit card. So basically, if you default on your credit card, you just can take the money or they take the home that you put up for use as collateral. Revolving credit payments are typically due monthly, okay? Unlike non-revolving or installment credit, there's an option to pay a minimum payment, the full balance, or any amount that falls in between the two. That's where the relief come in at with using revolving credit. It gives you a longer period of time to pay for some of those items that you want. Your minimum payment is determined by the outstanding balance carried at the end of each billing cycle. It is also affected by the APR on whatever credit line you have. The minimum payment is usually a fixed dollar amount or a percentage of the total balance, whichever amount is higher, assuming there's a balance at all. So they're just saying your minimum payment, they calculate your minimum payment by basically seeing what your ending balance is, and then they calculate it used as a percentage of that total balance. So be sure to understand how your minimum payment is calculated, even if you're planning on paying more than the minimum or carrying a balance at all. Okay, as the revolving credit is used, a running balance is total. If the outstanding balance is paid off in full before the end of the billing cycle, no interest is applied if a balance is carried over, and then the monthly payment consists of a principal balance plus any fees and interest charge. So if you carry a balance from month to month, they're going to hit you with the interest. That's when the interest and the fees start to show themselves and start to calculate, and they can add up real quick. So you want to make sure that you pay your payments off every month. Pay it back down to zero, let it report to the bureaus, then you can use your card again. Okay, available credit limit is restored as payments to the revolving account balance are made. So if you buy something, make a payment, that money recycles itself as that payment post. Any balance carried over is affected by compounding interest. Basically, here go an example. If you have an outstanding balance of $200 and you have an interest charge of $20 and you paid nothing on it that month, your charge of interest for the next time interest is calculated will be $220. Now, this can make credit card debt and other revolving debt more difficult to pay off if you let balances spiral out of control. So you want to make sure you stay on top of these things. Now, let's discuss what are some examples of used revolving credit. Okay, for example, just say if you was having car trouble and it breaks down on you and you consult to a mechanic and he said he quotes you a $2,000 fix to fix this issue. Now, currently in your checking account, you only have $700. Now, but you need your car to get to work, pick up the kids, and run any other errands that you got to run. Now, you're in the pinch, right? Because without credit, you can afford the extra $1,300 to fix the car. So you also can afford the alternative of losing your source of transportation to make your income, you know? So this is where revolving credit will help out wonders, because using revolving credit like a credit card or a personal line of credit allows you to access the funds to pay for that auto repair, and it gives you the flexibility to pay the $2,000 over a stretch of time instead of all at once. So you can use your portion of the next several paychecks to pay off the balance instead of the entirety of the next check you receive. So you can stretch that $2,000 out over time, because now since you got that $2,000 of revolving credit, you have some leeway. You at least have 30 days before you have to pay that $2,000 off, so you won't gain no interest on that money, okay? So in this scenario, you'll be using the credit card or personal line of credit, which are the two examples of revolving credit. What if you're trying to complete renovations at your home? If you've been through renovations like I have, you know that sometimes costs run over budget. Without extra funds to pay for unexpected overages, now you could be sitting in the construction dust for much longer than you anticipated. This is where applying for a home equity line of credit can cover additional construction costs without delaying the renovation. Simply transfer the additional funds to your bank account or write a check from the HELOC to pay the contractors. In this instance, a home equity line of credit is a revolving line of credit that you can use to pay for them items secured by the value of your home. Now, how large your line is will be influenced by how much equity you have in your house. The value of your home less the balance you owe on any mortgages. These are three types of revolving credit. Revolving credit can be divided into either secured or unsecured credit. Secured credit means the collateral is required to qualify for an account, while unsecured means that the creditor is also using the credit profile to determine that you don't need to put up any collateral before issuing this line of credit. Now, it's important to know both what type of revolving credit is best suited for your purpose and whether it's secured or unsecured. And the first type, which is the most common type, the most popular type, is credit card. Credit cards don't typically require any form of collateral unless you get a secured credit card. Unsecured credit cards are considered a high-risk products for banks and financial institutions, since they sometimes allow people to spend beyond the means and fall into a never-ending cycle of debt. Now, as such, they usually assign higher interest rates for credit cards that can fluctuate with the market rates. Average credit cards interest rates hover around 15% to 18% for well-qualified borrowers. However, they can reach much higher for borrowers with credit issues. That's why there's a lot of, credit cards out there that they shoot the interest rate up because they're considered as bad credit cards. And those are the ones with the annual payments. And you got to pay it regardless if you use the credit card or not. And it always, for some reason, even though it's only once a year, some reason that annual payment always sneaks up on you. It always sneaks up on you sometimes. Now, credit cards have potential to earn reward points on purchase made. These reward points can be anything from cashback, points, or travel mileage. If you're using a credit card, your credit score will be best impacted by keeping your balances low relative to the total approved credit line. Ideally, between 2% and 9% of your approved credit line. That's when you want to keep it that low if you're going in trying to apply for other things, because you want to make sure that your utilization is very low, okay? But on normal days, I would say 30%. That's the cool number to try to stay below. However, making on-time payments of at least the minimum balance is ideally the way you want to go when dealing with credit cards. You want to make sure that you're making your payments on time and at least make the minimum payment, at least. Well, I say to save yourself money, you might don't want to believe this now, but I guarantee you it's true. To save yourself money, you might want to just pay whatever the balance is. Pay it all the way off. I know you may think that you're losing dollars, but in actuality, you really are gaining a lot more than letting that balance travel to that next month. Because once they start to tack on those fees and interest, you're going to see that, man, they got fees and interest for every type of scenario. So that's something that you want to be sure you pay attention to. Next type of revolving credit would be personal lines of credit. Now, personal lines of credit is a unsecured credit line that's similar to credit cards, but with a few key differences. First of all, there's usually no card associated with a personal line of credit. That might seem like a restriction, but really it isn't. Instead of a credit card, you can transfer funds from your personal line of credit directly to your bank account, so it can be used just like cash. To do the same thing with a credit card will create a cash advance, which comes at a much higher interest rate than other transactions. Personal lines of credit are typically have lower interest rate than credit card. On average, a personal line is usually around 10% to 12% for people with approved credit, I would say. And the third, but definitely not least, I would say a HELOC, which is a HELOC, a home equity line of credit, can be used. Basically, you using the equity in your residential property to extend credit to the homeowner. Since you're using a house as collateral for the line of credit, these often comes at a much lower interest rates than typical credit card. The interest rate usually are under 5% for most borrowers with good credit. So now you ask yourself, is revolving credit a good idea? And I will ask you, is a pig considered pork? Now, if we was on another platform, I would have said that a lot different. But as long as you manage your accounts well, revolving credit can provide a boost to your credit score. The most important number to pay attention to with any revolving credit is your utilization rate, calculated by dividing your total balance by the size of your credit line. Utilization alone makes up 30% of your total credit score. Now, if you check out the last video, I did a whole video on utilization, breaking it down, giving you tips and tricks on how you can manipulate utilization to help you out in dealing with credit cards, because it's a skill that needs to be developed. So it's best to keep your utilization under 30% of your credit limit to avoid any negative impacts on your credit score. And most experts, myself, recommends keeping your utilization between 2 and 9%. 6 is the perfect number. If you let your credit utilization get out of hand, it could contribute to difficulties paying off your revolving debt and lowering your credit score. Okay, we about to wrap it up here in a second, but I want to tell y'all and inform y'all basically on how revolving credit impact your credit score. Now, the impact that revolving credit has on your credit score depends on how you use it. Having both revolving and installment credit impacts your credit mix positively, which can help your score. For some people who pays their monthly payments on time every month and keeps their credit utilization low, a revolving credit account could create a substantial increase in your credit score, especially if the account is kept in good standing for multiple years and contribute to the age of your accounts. A borrower who maxes out their credit cards or has trouble keeping up with their payments will most likely see a decrease in their credit score. For the best effects on your credit, you should use your revolving credit responsibly. I shouldn't have to tell you that. That's just something you already know, right? You're an adult, you know this. Don't spend more than what you can afford. I understand they might give you a credit limit that's from $5,000 to $10,000. Basically, use it to help you. Do not use it at your detriment. Because if you can't pay $5,000, don't use $5,000. It's basically someone is giving you extra cash to help you out in jams that you may find yourself in. But don't just go out and purposely just use it on nonsense, because that's how you create binds for yourself. Because credit cards are made to cover you in emergencies, improve household cash flow, or even protect your cash accounts from fraud. Now, it can be easy to let your revolving credit get out of hand, since the interest rates can be high and the interest is compounding. However, with conservative use of your revolving credit accounts, you can see big changes in your credit profile. That's what it's all about. It's about using things to improve your credit to get more things. You risk yourself to get the asset, which is the credit card, and now you spend the credit card so you can save your cash. You see how that works? It makes sense. You just you got to make sure you're using the system the correct way, I would say. Okay, there you have it. Another one in the books. I hope y'all got some out this video. Like I say, my name is Major Wala. I thank you for joining us today. If you have chance, you feeling generous, go check out some more of the other videos and learn some more important information that you may need. Because you know this channel is all about seeing the American consumer do better and be better. Thank you for joining us, and peace.